Leaving money in a standard checking account guarantees a loss of purchasing power over time. As inflation steadily increases the cost of living, the actual value of uninvested cash strictly declines. This chart shows the long-term mathematical reality of that cash drain compared to the stock market. While the cash line slowly bleeds out over a 20-year horizon, the invested capital sharply accelerates upward. The interest you earn begins earning its own interest, creating an exponential growth curve. The most accessible way to capture that growth is through a passive, automated strategy. You open a tax-advantaged account, like a PEA in France, and purchase a globally diversified product, such as an MSCI World ETF. This single asset instantly spreads your capital across hundreds of the world's largest companies. To execute this, you apply dollar cost averaging. You invest a set amount of money on the exact same day every month, regardless of whether the market is up or down. This mechanical routine removes the stress of trying to time the bottom of a market dip. Long-term wealth creation relies entirely on this kind of emotionless consistency. Moving from a passive ETF to active stock picking means you are buying a fractional piece of a living business. You have to look under the hood to assess its financial health. This dashboard shows the price-earnings ratio, or PER. It tells you how many years it takes for a company to repay your purchase price using its current profits. A high-growth tech company will naturally carry a higher PER than a traditional bank. You must evaluate these numbers by separating them by sector, rather than comparing them directly. Next, you check the debt-to-EBITDA ratio. This measures how much debt the business holds relative to its operating cash flow, serving as an immediate gauge of bankruptcy risk if interest rates rise. Fundamental analysis answers the question of what to buy. It filters out fragile businesses and ensures you only allocate capital to companies with resilient balance sheets. An excellent business becomes a poor investment if you buy its stock at the wrong time. Traders read price action using Japanese candlesticks. Each candle visualizes the daily psychological battle between buyers and sellers, showing the exact high, low, open, and close of a trading session. This chart shows how that price action interacts with psychological zones known as supports and resistances. Look at the V-shaped dip on March 16, 2020. The price plummeted, hit a floor where buyers aggressively stepped in, and established a definitive line of support. To confirm these zones, we track the 200-day moving average to identify the overarching trend. Simultaneously, the Relative Strength Index, or RSI, drops to the bottom of the screen. Dipping below 30 signals that the selling pressure is completely exhausted. This image displays a test scenario. You have a company with an expensive PER of 85. The price is trending below its moving average, and the RSI sits in neutral territory at 60. Do you execute a buy order? The correct answer is no. The asset is too expensive on a fundamental level, and the technical indicators show a broken downward trend with no signs of buyer exhaustion. Technical analysis dictates exactly when to buy, protecting your capital from catching a falling knife. Professional traders do not spend their days predicting gains. They focus almost entirely on managing their losses. They enforce this using a stop-loss order. If the market moves against their prediction, this order executes automatically, cutting the position before a small loss becomes catastrophic. This balancing scale graphic illustrates the mathematics of survival. Professionals adhere to the 1% rule. They never risk more than 1% of their total capital on a single trade. For every unit of risk placed on the scale, they target at least 3 units of reward. By maintaining a strict risk-to-reward ratio, a trader can endure a continuous string of losing trades and still remain profitable over the long run. This screen tracks a complete trade. First, the fundamental check verifies a healthy PER and low debt. Second, the technical check shows a bullish candlestick bouncing off support. Finally, the risk check uses a limit order and stop loss, ensuring risk never exceeds 1%. This checklist documents the complete methodology. You build stability with a passive DCA base, filter targets with fundamental analysis, time your entries with technical analysis, and protect your capital with the 1% risk rule. Stock market investing relies entirely on probabilities, patience, and rigorous risk control.